You've come with a very rosy picture about the commercial real estate market when we get so much data that says quite the contrary. I'm going to go to the JL report for Q1. Commercial real estate leasing down 25% compared to pre-pandemic. So you have some questions about our reporting, but that's from JL, very reliable source. Does that kind of jive with what you're seeing? Q1 ended a couple weeks ago, obviously. Now we're in Q2. Does that kind of go in with what you're seeing?
Great to be with you. Let's talk about the definition of rosy. Because it's all relative to the amount of negative headlines and generalization that we observe happening in the marketplace. There is office space and there is everything else. Commercial real estate consists of apartments, self-storage, hospitality, retail, of course, and many other subsectors that are doing much better than office buildings. So office buildings have been hit by the demand side of the equation. We know this about the hybrid workspace and the pullback in tenant demand. At the same time, interest rates having doubled from where loans are maturing versus where they've been. Of course, that's going to be a compounding effect, and office is in a whole different category by itself. So commercial real estate as a whole has not been overbuilt. There are pockets of overbuilding. And the fundamentals, because the economy's done well, have held up really, really well across non-office product types. So now let's take a look at office for a moment.
Wait, before we get into office, so I mean, even you admit that some office buildings are sold at steep discounts.
No question, and they have to. And the reason for that is because those are older, obsolete assets that are very difficult to reuse and very difficult to re-tenant. Therefore, it's not surprising at all to see the kind of 60, 70% decline from peak or from where the previous sale was. Even within office, though, that constitutes a fraction of the overall inventory of office space. Suburban office is doing much better than urban, for example. They're not distressed. And a newer office buildings have attracted tenants, therefore they're not distressed.
All right, that's a fair point. I want to go to another data point from this JLL report. We have some of your data points as well. But large commercial real estate tenants with expiring leases, they cut the space that they were leasing by 11.5% in Q1. Does that also go along with what you're saying? That,
yes.
That people are re-signing, but they want less space.
Yes, no question. There's more efficiency. There is, kind of a reconfiguration of traditional offices to more teamwork and collaborative environment. All that reduces footprint, and we are seeing that also.
So, I mean, you want to straighten this out. At least last time you did. Even when we were talking off camera, you want to straighten this out this time. So what's the real picture? What's really going on with commercial real estate? How good or bad is it? And is there risk of contagion that might impact banks and other parts of the economy?
The answer on the contagion front is to some extent, because when you have a 70% discount on an asset that sells, an investor buys that, reuses it, and can release it at much lower rent. So there is a little bit of a kind of undermining of the overall market in rents when assets discounted at such steep levels come back into the market.
Right.
However, office space constitutes less than 4% of total bank loans within commercial real estate. So that's why we have to kind of zoom out and look at the whole industry. What we're seeing, as I've mentioned the last couple of times I've been on the program, time is bringing prices down. On average, we've seen 20 to 25% price adjustments since peak across all commercial real estate sectors, and that's bringing buyers back. Record capital on the sideline is now aggressively pursuing these assets because they've been repriced. And that's before the Fed helps the industry by lowering interest rates just yet.